Hi, I'm Marty Switz, the CEO of Contango Asset Management. With me today is our business partner, Paul Black, the CEO and Portfolio Manager at WCM Investment Management. Paul, thank you very much for being with us today in these very challenging times or extraordinary times.
Yes. Thank you, Marty. Great to be with you, and good morning to everyone.
Paul, what really gives us confidence at the moment, in times of, severe volatility and what's been a very savage market pullback is, the experience that yourself and Kurt, the WCM investment team, have through these sorts of, market pullbacks. Before we sort of talk about the portfolio and how it's holding up at the moment, could you just sort of set the scene, what it's like in the US at the moment? Are you in shutdown, and what's the general vibe and mood like right now?
Yeah, we actually are in shutdown in Southern California. Actually, most of California we're in shutdown. So, we did close the office. We've fortunately had extenstively tested remote abilities to work. We do that every year for the last 5 or 10 years. But consider that people are panicked. And I think the panic is kind of the greatest concern, more so than the realities of what the potential with the virus is going to do. So yeah, there's a lot of uncertainty here. I don't know how long the people will listen to staying in their own homes and not going out. But the only thing that people are doing right now is, as I'm sure they're doing in Australia, running to the grocery store and hoarding the toilet papers and the rice and the chickens, and there's plenty of where I've been out doing it, and the reality is there's plenty of food, and there's not a lot to be concerned about as far as getting what you need on a daily basis.
No, there's definitely a lot of bunkering down of the hatches here in Australia. So Paul, let's get into the portfolio, how you see things at the moment. What are the key features of the WCM investment process, and why is it particularly effective in falling markets like we're experiencing at the moment?
Well, it's gratifying in this complete chaos and rapid sell-off in only 3 or 4 weeks that the portfolio is actually acting how we design it to act, which is in very difficult periods of time when there's dislocations in the market. Our expectation is that we're going to do far better than the market when the market's down. So while the markets across the globe are down anywhere from 30 to 45%, depending on what particular index you look at, our portfolio right now is down about 20%, maybe 21%. So the names in the portfolio have held up really, really well. That's by design, and it goes to kind of the philosophical underpinnings of what we do as a manager, which is to own those businesses that you've heard us talk a lot about, where we can make a strong case that the economic mode or the competitive advantage is actually getting stronger. And we have found through history and market tests back in 2008, 2011, 2014, we've done extraordinarily well in those period of times, and so that notion and philosophical underpinning of owning those businesses that we think have a high likelihood of getting better in market dislocations vis-a-vis everyone else in their industry is holding up really well. And again, coupled with the idea that what ultimately drives the competitive advantage to grow in a business has everything to do with the corporate culture or the set of values kind of inside the business that animate that business. So the combination of owning companies with expanding competitive advantages, usually they do extremely well in difficult markets. And the beauty is because their weaker cousins in their industry tend to suffer during periods of dislocation, they actually get stronger and stronger and stronger. So when the turn inevitably comes, the companies that we own with great culture supporting a growing competitive advantage tend to lead out from here. So, again, nobody likes to go through this, but the math is overwhelming that if you lose less in difficult markets, obviously you don't have to do as well in rising markets. We think that we're well positioned going forward for the next 5 and 10 year pull. And that's the important thing, right, Marty, that that are investing in equities think in terms of decades, not in terms of weeks or months or quarters or even years. But if you can invest with an eye towards the next 10 years, then this is going to be an extraordinary time that you'll look back on and really wish that you would have allocated more capital to the equity markets.
Well, the portfolio performed particularly well in the GFC. Are you seeing similar opportunities now as what you saw back then?
We are. It's the same kind of carnage where really great companies are getting dragged down with poorer quality companies. And as a portfolio manager, when you're thinking again in terms of decades, it's a great time to kind of upgrade the quality of the portfolio to own businesses that you think will be the leaders for the next 10 years. So what we've kind of done from a portfolio management side during this crisis is we've started to move away from some of the names that we would consider defensive in nature. I don't want to name names, but examples of a defensive company that held up well might be a McDonald's. You could look at a Costco. Costco, probably the same thing down in Australia. Costco is going to have a phenomenal quarter or two or three because of the hoarding that's going on. But those are names that have done extremely well. So our idea is take a little bit of money from those more defensive growth companies and then begin to reallocate towards companies where they've been pulled down 40 or 50%, and the long-term economics of those businesses are not going to be impaired by what's going on kind of collectively around the globe. So as the market turns and as everyone says, nobody rings a bell at the bottom of a market, but what you want to do is you want to begin to position yourself for that period of time when in fact it will turn, and therefore the next 5 and 10 year returns we expect to be every bit as good as what we've delivered in the past 5 and 10 years.
Yeah, Paul, it's obviously all happened very quickly, the current scenario that we sort of find ourselves in, but what are some of the companies that you're invested in telling you right now about the current environment?
Well, what we had done a couple years ago, and you saw us do this, Marty, is we had kind of moved away from some of the more aggressive technology names. A lot of managers have been riding technology companies every day, all the time, had great returns from them, but we began to feel a year and a half or 2 years ago that those companies, while great, and I'm talking about the Amazons of the world, I'm talking about the Facebooks, the Googles, the big, ubiquitous technology companies, while they were still really good companies, we didn't feel that they were companies where we could make the case that the moat was actually expanding. So we did sell those names in the portfolio and began to move into names that we thought might make the next leg up. And you've heard us talk about Shopify as an example in the portfolio, which is to us kind of an early stage Amazon, a little bit different, but very similar in terms of working with the disintermediation of traditional retailers around the globe. One of our favorite companies, which we would own in the global portfolio, is right in your backyard, CSL, which is a tremendously successful plasma company. We have put that in the global portfolio. But I know that when we talk about Australia, it's an ex-Australia portfolio. That's a fantastic idea. And frankly, the area that surprises us the most are some of the healthcare companies. There are some really good quality healthcare companies in the device area, knees, hips, other types of medical device companies that have been, again, crushed because there's this notion that people will put off non-essential surgeries in order to make room for the critical people that are going to be in the hospitals theoretically over the next 6 months or so. We find that not to be a reasonable assessment of the future. So we actually think some of the healthcare names that are down 40 or 50%, but kick out tremendous amounts of cash flow, are going to be a really good place to be. And certainly in 6 or 9 months, if people did postpone a knee or a hip replacement, that's not going to be postponed forever. And so we really believe that healthcare area where we've always been kind of heavy, or at least in the last couple of years, there's some very good opportunities to buy high quality businesses there. Now remember, we don't buy biotech companies or even big pharma companies where you tend to have binary outcomes. You do tremendously well if a particular drug happens to be approved and take off, but you can also do very poorly if there's no approval. So we tend to play more of the picks and shovel ideas in healthcare. We found that's a much more conservative way to invest in healthcare, but we do think kind of going forward from here, that's going to be a very nice, soft way to participate in the growth going forward.
Paul, one of the questions we've had from some clients is, how are the research team dealing with the sort of restricted access that they would have to companies at the moment in the current COVID world?
It certainly, if it went on for a year or two, there might be some issues. Although, again, just as we're doing a video conference and able to get access through the web, it's the same thing that we're doing with the companies that we have in the portfolio. So it's very easy, and certainly with our size now and a decent amount of we get a decent amount of access across the globe. And instead of doing face-to-face meetings, we're doing more video conferences, a lot more telephone calls. The access has not changed at all. This is an interesting test case for the World Wide Web and our ability to, through technology, to stay connected with people. And we believe we can continue to do that for quite some time.
So the companies that you're having the portfolio at the moment are still open for business in terms of communicating with you and sort of open to taking meetings?
Absolutely, not a problem at all. We had a trip scheduled for 10 days to Japan about a month ago. That was canceled, but we were able, again, through technology, to access the CEOs and the CFOs of the businesses that we really wanted to talk to.
So, Paul, who do you see as the winners and losers of the coronavirus so far? And I guess probably more importantly, are you seeing any long-term opportunities at the moment?
That's what we're kind of wrestling through right now. I've got this notion, which I think is probably not unique, that after this settles down, it seems pretty obvious to me that there's going to be a rapid move away from China as kind of the supplier of toys throughout the world. And I think there's going to be a massive shakeout in China in terms of manufacturing. You'll probably see it move to other countries in Southeast Asia, whether it's Thailand or Vietnam or Cambodia. I think in North America, we'll see a lot more manufacturing capabilities come back to Mexico because there's really not a huge price advantage anymore to go to China, and kind of with the number of dislocations that China's causing in the markets is going to make people think twice about doing business there. So that's an interesting one. Do you still invest in China and expect the same rate of growth over the next 10 years? Probably not. But there's other opportunities in other countries where we're beginning to sift through to see if we can find some good ideas that'll benefit from that movement. But I'll tell you, what's interesting is if you look at, everybody talks about value managers and how value managers always have a margin of safety. And, we've been coming down to Australia for, I think, 8 years now. And the question we get every time we come down to Australia is, wow, growth has done so much better than value for so many years. Do you think that can continue on? And, of course, the answer to that is, yeah, I think it can continue on. Just because it's outperformed for a lot of years doesn't mean it can't continue to outperform. And I actually have said this before, I actually believe there are structural disadvantages to be a pure value manager than there are to be a pure growth manager. And, in this downdraft, you're seeing value guys down 40, 45, 50%. And that's because the nature of a value manager means that they're going to own those banks, a lot of European banks that are going to suffer. Yeah, a value manager is going to own a lot of commodity businesses, a lot of basic industry and industrial companies that are absolutely going to get hammered and clobbered. So that whole notion that value is positioned to do better than growth. It's hard to see. You'd expect me to say that, but I think the kinds of businesses where, that are still tied into the ability of people to make more money and get wealthier, and that's where they're going to spend their capital on, consumer names, healthcare names, and tech names. I mean, my gosh, healthcare names over the next 3 to 5 year poll ought to be a beautiful place to be. Tech's, as we see downturn, tech's going to be a great place to be. And of course, really high quality consumer names, they're still going to lead going forward. I'd much rather make that investment bet on those names versus buying European banks or a lot of mining companies or industrial companies going forward.
Paul, we've talked about this a lot over the journey so far, but the turnover in the portfolio has always been low. Has that changed at all through this sort of current period of volatility?
I think you'll see a little uptick here. I actually had a call with the other portfolio managers on the strategy this morning, and was encouraging us to not just fiddle around the edges with the portfolio, meaning let's not just do 2 or 3% turnover, to move from defensive names to more secular growth names that have long-term tailwinds. Let's be a little bit more aggressive than that and move maybe 7, 8, or 9, or 10% of the portfolio into those names that will really lead out in the next year. So yeah, I would argue that historically we're probably around 22 or 23% turnover. You might see it tick up because we want to take advantage of the opportunities that are presenting themselves in the market right now. And again, certainly I commiserate with anyone that's on a fixed income and they've seen a drawdown in their portfolios across the board. But to anyone that has cash, it's an incredible time to allocate. When you remember, we all know what Buffett says, right? When people are fearful, be greedy, and people are unbelievably fearful, unbelievably panicked, and it's a great time again to allocate capital. It doesn't feel good, but I would argue it never feels good when it's right. It feels good to buy the market when the market's topping out. That feels good, but that's a disaster. It never feels good to make allocations of capital in markets like this. But fast forward 10 years, you're going to be handsomely rewarded.
Paul, before we go, any closing remarks you'd like to leave to our clients?
Well, I wish that I could have seen your clients. We were scheduled to be down. Yeah, right about this time. Love going to Australia, and I just
love
hope
having you.
Yeah, that we'll be down there soon, and we'll get to see everyone. But the main piece is, panic crushes returns. If you think about, if you had to guess right now what Warren Buffett is doing with the $130 billion of cash in his arsenal, what do you think he's doing? Do you think he's running for the hills and selling his stocks? No, I guarantee you, what we're going to find in 6 months is that he probably put $60 to $70 billion of that cash to work. And so, it's pretty simple when you're not emotional about your money. But when you can step back and say, look, what's rational and what's reasonable right now? And what's rational and reasonable is you can buy companies for a 50-cent discount from what you could have bought them a month ago. Inevitably, unless you think the world is ending, that's a pretty good risk-reward ratio.
Paul, thanks for your time.
Thank you, Marty. Wonderful to see you.
Thank you. And thank you to all our trusted clients for making the time to listen to this webinar today during these challenging times. We're very grateful for all your support. Our team is accessible. We've got remote working arrangements taking place at the moment, but if you need anything at all, feel free to email your respective contacts or invest@contango.com.au or call us on 1300 001 750. We appreciate your support. Stay safe, and we'll be communicating on a regular basis. Thank you very much. Have a great day.